Today, we're literally putting on our detective hats to solve a completely thrilling financial mystery. We're diving deep into a concept that honestly causes a lot of panic for business owners and accounting students alike. But by the end of our time together, you're going to see exactly how to crack the case. We're talking about the bank reconciliation statement, and we're going to master it by solving the case of the missing rupees. So grab your magnifying glass and let's jump right in. All right, let's set the scene by meeting our protagonist, Raju. So Raju runs a really bustling local business. It's the end of the month, and he confidently flips open his business ledger. He's looking specifically at the bank column of his cash book. He checks the bottom line, totally expecting to see a very healthy balance. And sure enough, according to his own meticulous daily records, he has exactly 50,000 rupees sitting safely in his bank account. He's smiling, feeling pretty good about his hard work this month. But wait, here comes the shocking twist. Raju walks down to his bank just to update his physical passbook, the bank's official record of his account. The printer buzzes, the teller hands the little book back to him, and Raju looks at the balance. It reads 42,000 rupees. Cue the dramatic anime-style sweat drops of absolute panic. His own book says 50,000. The bank says 42,000. So, what does this all mean? The absolute most crucial question right now is where on earth did Raju's 8,000 rupees go? Was it stolen? Did some hacker get into his account? Did his accountant just make off with the cash? Well, don't panic, Raju, and viewers, don't you worry either. I'm actually inviting you to step up as the senior detective today. Together, we are going to solve this financial mystery by building what we call a reconciliation bridge. Okay, so to solve this, we first really need to understand the two mirrors concept. One mirror is the cash book. This is Raju's mirror. It strictly reflects his perspective of his money. The other mirror is the passbook, or the bank statement. Now, this is the bank's mirror. In a perfect, magical world, these two mirrors reflect the exact same pool of money. But here's the secret to our whole mystery. Sometimes the reflection in one mirror is just delayed. They're both looking at the same reality, but one is lagging a bit behind the other in time. Now, here is the absolute golden rule of how these two mirrors operate. You gotta memorize this. A debit balance in Raju's cash book equals a credit balance in the bank's passbook. Why is that? Well, because when Raju deposits money, it's an asset to him, right? So he debits his book. But think about it from the bank's perspective. They now literally owe Raju that money. It's a liability to them, so they record it as a credit. They're just two sides of the exact same coin. So if the mirrors are supposed to show the same money, why do they disagree? Well, we've rounded up the 4 usual suspects that cause this exact discrepancy, straight from our source material. Suspect 1 is timing differences. Suspect 2 is transactions recorded by the bank only. Suspect 3 is direct deposits by third parties. And Suspect 4 is just good old-fashioned human errors. Let's interrogate them one by one. Let's bring in our first suspect and see how this actually plays out. The time lag check. Imagine Raju issued a check to his flour supplier on, say, Monday. Raju immediately records this in his cash book, so his balance drops instantly. But picture that physical paper check floating slowly through the air. The supplier shoves it in his pocket, totally forgets about it, and finally goes to the bank on Friday. For 4 whole days, Raju's cash book is lower than his passbook because the bank simply doesn't know about the check yet. This clearing delay is practically always the most common culprit. Next up, we have the invisible and sneaky suspects. Suspect 2 involves these silent, behind-the-scenes actions by the bank. For instance, the bank might just automatically deduct 200 rupees for SMS alert charges, or maybe some incidental fees. The passbook balance drops instantly, but Raju's cash book is completely clueless until he actually gets the statement. On the flip side, Suspect 3 is the sneaky depositor. A really loyal client might pay Raju directly via a NEF transfer right into his account. The bank balance shoots up, but again, Raju's cash book is completely unaware of this extra cash until he actually checks his account. And this perfectly illustrates how we actually crack the case. Let's apply a super simple logic test to Raju's case file. Just ask yourself, does the bank currently hold more or less money than Raju's book thinks? Take that first scenario. A check was issued but not presented. That means the bank hasn't actually deducted the money yet, so the bank has more money than Raju's book. To bridge the gap, we just add it back. Look at the second one, bank charges. The bank quietly took money out. The bank has less, so we must subtract or less it from Raju's book to match. It's just pure, beautiful logic, right? All right, now that we have our suspects and our logic locked down, let's actually construct the official reconciliation bridge. Using the exact pro forma from our source text, you start right at the top with the balance as per the cash book. Then, you literally just list out your add items, things like those unpresented checks or maybe interest credited by the bank. Below that, you list your less items, stuff like checks deposited but not yet cleared, or those unrecorded bank charges. You do the basic math, and miraculously, your final number at the bottom matches the passbook balance perfectly. Just to ground our investigation for a second, Raju got his initial 50,000 rupee figure directly from his double-column cash book. Notice how it has a specific column for bank right next to cash. Our source material notes that when you maintain this specific bank column, it actually serves the entire purpose of a bank account in your ledger. So the starting balance for our whole reconciliation puzzle is pulled straight from the bottom line of this exact document. But hey, every good detective story has a scary plot twist, right? What if Raju had actually withdrawn more cash from the bank than he ever deposited? This creates a negative balance, which is known in accounting as a bank overdraft or an unfavorable balance. Now, here is where you really have to pay attention. If you start your reconciliation statement with an overdraft balance, the rules of the game completely flip. Items you would normally add, you now deduct, and vice versa. It is literally the upside down of accounting. Before we completely wrap up the case file, I want to give you a pro tip shortcut that is an absolute lifesaver. Think of reconciliation as a journey. You have a starting point, let's say the cash book balance, and you have a destination, which is the passbook balance. Just ask yourself one simple question: what did the destination do? If the destination, the passbook, is higher because of a transaction, you add. If the destination is lower, you subtract. Seriously, just follow the destination and your math is going to be flawless every single time. As this fantastic quote from our source material perfectly summarizes, reconciliation of the cash book and the bank passbook balances amounts to an explanation of differences between them. Honestly, that's the biggest takeaway here. Raju wasn't robbed, the bank definitely wasn't lying, both the cash book and the passbook were technically correct in their own timelines. They were simply separated by a temporary information gap. We didn't miraculously change the actual money, we just explained the difference. So the mystery of the missing 8,000 rupees is officially closed. Raju can definitely stop sweating now. He just had a couple of uncleared checks and a surprise bank fee. Next time you look at your own accounts and the numbers just don't line up, please don't panic. Just put on your detective hat. Are you going to look for a time lag check, maybe a sneaky direct deposit, an invisible bank fee, or just a clumsy typo? Build your bridge, and I promise you'll always find your money. Thanks for joining me.
Hi guys, hope you all are keeping well. I hope you already understood the concept of BRS. What is the requirement, what is the need, and how to reconcile it. Correct? Because need is very simple. That because owners of the business maintain their own cash book and bank maintain their bank accounts and all. So there are always some type of variances which need to be reconciled to match both the balances. To have a better understanding, we added one more example, so you just see that also, so you will have no doubt after that. Still you have any doubts, you can comment in this video, so we will try to clarify it. And please like, subscribe, and keep commenting on our videos.
All right, let's solve a high-stakes accounting mystery. Today, we're stepping into the shoes of the practical detective to help out a small business owner named Raju. Now, Raju is dealing with a super stressful problem right now, a really serious discrepancy in his books. So, we're going to break down the exact steps to solve this using a bank reconciliation statement, but don't worry, we're keeping it completely jargon-free. So here's the core of our mystery. It's March 31st, the end of the month, and Raju is looking at his own records. His cash book shows a really healthy debit balance of 75,000 rupees. In his mind, he's got plenty of cash to cover his upcoming expenses. But when he actually checks with his bank, the reality is, well, it's a bit of a shock. The bank tells him he only has a credit balance of 62,000 rupees. I mean, picture poor Raju just scratching his head over this. There is a missing 13,000 rupees here. Where exactly did this money go? And honestly, who's right, Raju or the bank? To crack this case, we literally need to treat the bank statement, or the passbook, as our primary crime scene, because this official document records every single deposit and withdrawal, but from the bank's perspective. Our job today is to cross-reference Raju's personal cash book with this bank statement so we can build out our evidence list. By comparing the two side by side, we can spot the exact moments where Raju's expectations completely diverge from the bank's reality. Okay, so after a thorough investigation of both books, we've compiled a timeline of Raju's real-world transactions over the last few kind of frantic days of March. And this timeline right here holds the key to the mismatched balances. Look at this. On March 28th, he wrote a 12,000 rupee check to his flour supplier. Then on the 30th, he deposited an 8,000 rupee check from a catering gig. And then bam, on March 31st, a total flurry of automated activity hits his account. We're talking bank charges, interest, a direct UPI deposit, and an auto-pay insurance premium. It's a lot to keep track of, I know, but we're going to break it down piece by piece.
Now, to actually process all this evidence, we're going to use a single, super powerful logic filter. Every single time we look at a transaction, we just ask one specific question. Does this transaction make the actual bank balance higher or lower than what Raju assumes it is? That's it. We always start with Raju's assumption of 75,000. If the bank's reality is higher because of the transaction, we add it. If the bank's reality is lower, we subtract it. It's really that simple. Let's run our evidence through this filter.
All right, let's look at evidence piece number 1, that 12,000 rupee check issued to the flour supplier back on March 28th. Now, when Raju handed over that check, he instantly deducted 12,000 from his own cash book. He just assumed the money was gone. But here's the catch. The supplier just put that check in his pocket and hasn't actually gone to the bank to cash it yet. Because it hasn't been presented for payment, the bank hasn't taken the money out. Therefore, the actual bank balance is mathematically higher than Raju's assumption. So to reconcile this, we absolutely must add this $12,000 back to our starting figure. Conversely, think about the 8,000 rupee check Raju received from a wedding catering order on March 30th. Raju was thrilled, right? He deposited it and immediately added 8,000 to his cash book, assuming he had that cash ready to spend. But as we all know, clearing out station or interbranch checks takes a few days. The bank hasn't actually collected this money yet. Raju thinks he has it, but the bank's reality is lower. And because the reality is lower, we have to less or subtract this 8,000 from our starting figure.
Now this next part brilliantly illustrates the silent culprits of accounting. Automated bank deductions. On March 31st, the bank took out 250 rupees for annual maintenance charges. On that exact same day, they executed a standing instruction to pay 2,250 rupees for the fire insurance on Raju's stall. The bank just deducted this money directly. Raju literally had no idea this happened until he looked at his passbook today, so he obviously never subtracted it from his cash book. Because these hidden deductions made the actual bank balance lower than Raju's records, our logic filter dictates that we've got to subtract these amounts as well.
Well, fortunately, not all surprises are bad. Raju also had a few pleasant surprises that totally slipped under his radar. First, the bank credited his account with 1,500 rupees as interest on his savings. Plus, a regular customer, the office canteen, directly transferred 4,000 rupees into Raju's account via UPI without even telling him. The bank obviously knows about these deposits and they've increased his actual balance, but Raju's cash book, completely unaware of these unexpected incomes. Since these make the actual bank balance higher than his records, we definitely need to add these figures to our reconciliation. So, the absolutely crucial point here is constructing this reconciliation bridge. We start right at the top with Raju's assumption, 75,000 rupees. Then, in the plus column, we map out the items that made the bank balance higher. So that's the uncashed check, the interest, and the direct deposit. Then, over in the minus column, we subtract the items that made the bank balance lower, the uncleared check, the bank charges, and the insurance. By balancing these pluses and minuses against our starting point, boom, we bridge the gap straight to our passbook reality of 62,000. Mystery solved. We've perfectly traced the mathematical journey from the cash book assumption down to the passbook. Now, what we just did right there was build a standard bank reconciliation statement. But in the real world, there is actually a much more efficient, proactive way to handle this, and it's called the amended cash book approach. Let's take a look. So this approach happens in two distinct steps. Step 1, Raju proactively and permanently fixes the errors and omissions in his own cash book first. Think about the bank charges, the insurance premium, the interest, and those direct UPI deposits. I mean, those aren't going to fix themselves. Raju genuinely just missed them. So he records them permanently in his cash book right now to get an amended balance. Then, step 2, he prepares a much shorter bank reconciliation statement purely for temporary timing differences. These are things like the uncashed checks or uncleared deposits, basically things that will naturally resolve themselves in a few days anyway. It just keeps the books so much cleaner.
All right, time for a quick Finecology pro tip to really elevate your skills. When you're reviewing these statements, you absolutely must master the mirror rule. You might be wondering, why does Raju call his positive cash balance a debit, but the bank calls that exact same positive balance a credit? Well, it's because you are looking in a mirror. To Raju, cash in the bank is his asset, which is a debit. But to the bank, the money Raju deposited is a liability. It's money the bank owes back to Raju. And in the bank's ledger, liabilities are credits. Understanding this mirror rule ensures you never ever get confused by bank terminology again.
Let's look at one more pro tip before we wrap up. What if Raju was having a terrible month and his starting point was an overdraft? Now, an overdraft is simply a negative bank balance. He basically owes the bank money. If Raju starts with an overdraft in his cash book, he doesn't actually need to learn a whole new set of rules. He applies the exact same logic filter. He still asks, does this transaction make the actual bank balance higher or lower? The only difference here is that making a negative balance higher conceptually means pushing it further down into deeper debt, while adding money makes the negative number smaller. The core arithmetic logic never changes. To completely wrap up our investigation today, I want to leave you with a quick thought exercise. Imagine a brand new piece of evidence arrives tomorrow. Raju had deposited a 5,000 rupee check from a customer, added it to his cash book, but the bank just informed him the check bounced due to insufficient funds. Think about our logic filter for a second. Does this bounced check make Raju's actual bank balance higher or lower than he assumed? How would you adjust your reconciliation bridge to solve this new mystery? Ponder that as you review your own books. Thanks so much for joining me on this explainer, and I really hope this makes tracking your mismatched balances a whole lot easier.